Position Trading Bootcamp Day 5. So today we are going to be looking at the strategies. Okay, so all the strategies that I use to execute my trades, and we're going to look at the exact entry criteria that I look for and how to automate everything. I say everything, it's automating as much as you possibly can. But I'm going to be showing you my process basically that I go through, the tools that I use to execute the strategies, and why I do it this way. But everything that I do is fine-tuned over years to make my life really super simple, so that I have to spend less time in front of the charts. If you don't want to automate everything, and there is a massive benefit for not automating everything, which is chart time, then do it all manually. Yeah, all the tools are there and available. But there's one thing that stuck with me. One of my mentors said to me, in fact, one of his rules was he wouldn't mentor you until you'd spent thousands of hours in front of the charts. Yeah. And there is an awful lot to be said for chart time and watching and looking at charts, watching how they unfold. You build a muscle memory in your brain. And his rule was basically, I want you to read thousands of pages of information that I have on trading, and I want you to spend thousands of hours in front of charts watching them. And by the time you finish watching charts for thousands of hours, you will know what price is going to do next, because your brain will have seen those patterns playing out so much that they're imprinted on your memory. So when price gets to a certain point, you'll just go, right, next it's going to do this. And it is true. And I didn't believe him at the time, but now I've spent thousands of hours in front of charts. I know what's going to happen next. And it's all to do with the way that your brain absorbs energy, and the patterns you see on the screen get burnt into your eyeballs, basically. So I love automation, and it's absolutely brilliant, and it saves me loads of time. But without those thousands of hours in front of charts, I don't think I would know how to execute this automation today. So there's a lot to be said for chart time, but there's something you can do to speed up chart time. Is you can go into the simulator in MT4 and you can just watch months roll past at a time, spot how the market moves, see them pushing price to certain levels and then pulling back, see support and resistance playing out, see buying cycles happening and then seeing them sell after they've done that buying push. Yeah, and see it over and over again. But the simulator, the strategy tester, is brilliant for that, because it allows you to do months at a time, literally in 10 minutes. So okay, so let's get on with the presentation. So here we go. What I look for and why, how I enter and manage a trade, the setups, and how I extract the money. So this is the part you've probably been waiting for, and very patiently, obviously, over the last few days. So I'm going to explain the tools that I use in MT4, and I use MT4, obviously, so everything that I've built is for MT4. So these are the tools I use to find my entries and exits. And I'm going to show you all the detailed setups that I go through and examples of those setups. The process I use, I go through every day, and how I get alerted to opportunities, how I automate the vast majority of my analysis and my trading, my thought process when I'm entering a trade, how I plan my initial trade and then the additional entries if I need them, and what I do when things go wrong and how I get out of bad trades. Okay, so that last bit we've really covered yesterday in detail. So what I do when things go wrong, that's not really going to be covered too much today, actually, because we covered all that yesterday, didn't we? Advanced drawdown control and drawdown control. But everything else we're going to look at today is related to strategy. So first of all, quickly running through the tools that I use. We have covered these all in detail in the third day when we looked at indicators, but I'm just going to recap for you just as a refresher. So when we're going through the strategies, this is all fresh in your mind as to what they are and what they do. So those are the tools that I use. ADR dashboard alerts me when pairs are extended today. RSI dashboard alerts me when pairs are extended on higher time frames, so I can enter on lower time frames. Market reversal alerts indicator is my signal, my entry strategy. The EA automates 90% of my trading for me. The gap indicator helps me see areas to target or that where price is potentially going to reverse from. And the trade manager dashboard shows me my entire portfolio exposure at a glance, so I can see whether or not I should be getting in and out of trades. So these indicators are, apart from the gap indicator, all the other indicators are ones that I've developed myself because I couldn't find the exact ones that I wanted. So they're all fine-tuned basically to do exactly what I want in the way that I want them to do them. So these will either automate or partially automate my strategies. And as I said, you don't need them. You can do everything manually, but they allow me to spend minutes and hours per day trading rather than being attached to the charts all day long. But as I said, there's not a bad thing to be doing that. If you can sit in front of your computer and watch your charts while you're working, do it, because it's brilliant. You'll see things playing out. You'll suddenly see a massive spike and you'll go, there's a news event. And you'll know now, next time you see that massive spike, when you look back in the history, that was probably a news event. And there's lots of things you'll pick up like that, but you'll only see it if you watch the charts and see it happening and playing out. So covering the first two, ADR and RSI dashboards, these I use to alert me to extended market conditions and tell me to look at the chart to see if there is a setup I like, and B, it's ready now or getting ready, so that I can either put the EA on to start trading for me or have a look later on or tomorrow possibly. Okay, so I can see at a glance what is interesting and setting up, and it cuts my chart time down to literally minutes a day. So I have MT4 running in the background. Whatever I'm doing at my computer, MT4 is always running. In fact, I've got multiple MT4s running. And basically, I just react when I get an alert, okay? So looking at the dashes, those two dashes, right? So I've got them here. So the ADR dash is sitting there in the background. So this is my chart, okay? And I'm looking at whatever chart I want to look at, yeah? Just flick between the charts whenever I want to. The dashes, literally, I never look at them. They sit there in the background. All right, and when something hits ADR, I get an alert and it goes ping, have a look. All right, so then I'll flick over and I'll go, right, US dollar Swiss has hit ADR, hasn't hit ADR obviously today. Let's have a look at US dollar Swiss, where are we? And I'll start my analysis. Yeah, so that's what they are for. So I don't have to be sitting here watching this thing going, it's halfway, come back in 10 minutes. Does it move? No, right, okay. So that's literally what this is for. It's an alert system. So I don't have to look at the charts. I know what conditions I want. Remember, these are condition indicators. I know what conditions I want to trigger me to go and look, and that's what they do. RSI, any time I want to, I can open my RSI dash, look at it and go, Euro CAD, good looking trade. US dollar yen, good entries there. Okay, so this is the same thing, it alerts me. So I put this in the background, I'll have a look at it when I open my charts in the morning, see what's extended, have a look at those on the charts, and then I will sit there and minimize MT4. Every 4 hours, I'll get a ping from my MT4 saying, this has got extended, that has got extended, and I'll just go and have a look at it. So it cuts my chart time down to literally every 4 hours for that particular strategy. Yeah. With ADR, it will be any time of the day ADR can be hit. So at any time of the day, the other dashboard will ping at me and go, ping, I've been hit. Go and have a look at me. Yeah. So that's why I use dashboards, because they basically mean I do not have to look at my charts. Remember, all the strategies we've got contain multiple parts. We need a condition to be hit. The RSI dashboard tells me the condition is extended. The ADR dashboard tells me the condition is extended, i.e. possibly a good opportunity to take a trade, go and have a look. Yeah. So that's why I use the dashboards, and that's how they help me automate my trading. So I don't have to spend time in front of the charts continuously looking. If you didn't use that, all you would need to do is every 4 hours, set an alert on your watch, Outlook, I don't know, any calendar, or just set an alert basically every 4 hours to ping at you and go and have a look at your charts. So every time there's a 4 hour candle close, you go and have a look, flick through every chart. It'll only take you 2 minutes and see if there's any RSIs extended. That is the alternative, but I don't have to do that because this does it for me. Yeah. All right. So that's that. Market reverse alerts indicator. This indicator or dashboard, because it comes with a dashboard as well if you want it, is used to then get an alert on that pair. So the ADR RSI dashboard has alerted me that for example, the Euro CAD is massively extended. So what I can do is I can open up an MT4. Yeah. And I can put the market reversal alert. Let's say US dollar Swiss was what I was looking to trade. So I can put the market reversal alert indicator on the chart, and I can say to it, alert me next time there is a reversal alert in whatever direction. Yeah, so I say pop-up alerts, set that to true. Okay, and I'm only interested in long alerts. So next time this gives me a long, okay, I'll get an alert. So that's why I use the market reversal alert indicator, because that's why it's called the market reversal alert indicator. It's an alert indicator. So if you're trading manually, and you would need obviously this indicator to do that, when you get an alert on RSI or ADR, you can basically use the market reversal alert indicator to tell you now's the time to get in. You open up your chart, you press the buy or the sell button, simple as that. The next one is market reversal alerts EA. Okay, so the EA allows me to automate the majority of my trading, including initial entries and additional positions for a pair. And it can take profits at the levels I choose as well. So I do not use this as a set and forget EA. Okay, so what I do is when there is a setup I like, I will manually put the EA onto my chart, and I will say, right, set this up so that it takes trades for me based on the conditions that I want to be met. Right. Most of the time, I'll add it to the chart and say, just take shorts for me and space out my positions 1 ADR apart, please. If we get to 1 ADR in profit, close the lot and turn yourself off. Yeah. So I don't have to press the button to buy and sell. That is literally what the EA is doing for me. It's automating me as a trader and when I would get into positions. There's lots of settings on it. So you can set it up to do anything you want. You can also set it up to automatically get you into these strategies. And we're going to look at this working in a minute and trading for us. But we'll cover that obviously when we go through the strategies. So I can get an alert from the dashboard, analyze the chart and think, yeah, this is a great level to start my position. So I'll open up a chart on my VPS. I'll add the EA to it. And I'll basically say trade short, get me in every time we get a reversal alert until we've hit a profit target, and then get me out. Simple as that. Yeah, so it just automates me. The other beauty of that is while I'm asleep, I'm trading. Yeah, so if during the Asian session I'm in US dollar yen and there's a massive move on the yen, I'm not going to miss it because the EA is going to trade it for me. So it's basically me in the day replicated while I'm asleep. So two big benefits for using EA automation. And finally, sorry, missed one, gap indicator. Oops, sorry, gap indicator. That's not finally, that's the second to last. Gap indicator shows me the potential targets. We covered this one in detail. So basically, when I get into a position, this shows me where price is likely to be heading, because we know that these act as a magnet for price, don't we? So these are great targets to aim for. So I usually target the nearest gap that is either around ADR, an ADR away from my entry, and that is literally what I will use the gap indicator for. I don't use it for anything else, but where are we likely to be heading? Also, it's useful for, is there a target? Yeah, so if we get into a position and we're taking a long and we don't see any 1, 2, 3 gaps or propulsion candles above us, but we see 3 or 4 of them below us, we might be thinking twice about taking that trade. Yeah, so let's say, for example, we're about to, we get an alert to go long here, okay? And down here, we've got some propulsion candles from quite a while back, and we've been pushing down into them. We haven't quite reached them, and there's no propulsion candles above. The likelihood is this is probably not the best time to get in. Would be better to wait until we've got down here, because we know they act as magnets, and then we'll get an alert, then we'll get in. Yeah, so they have a use as well. Sometimes you will find that the market's been very orderly the way it's pushed down, and it's got targets to aim for down here, but there's none above. So sometimes it will help you in that respect. You'll look at a trade and think, actually, no, it doesn't look as good as I thought it did. And finally, the trade manager dash. The Trade Manager dash shows me at a glance where my portfolio is, what profit is available to take, where issues may be developing, what I need to start thinking about drawdown control being activated on, and my exposure. So this is my kind of cockpit, if you like. I haven't gone through this in any detail, the Trade Manager dashboard, but you can find it on MQL5. There's links in the Telegram group to it. Go and have a look at it, and it's very straightforward what it shows you. It shows you your exposure, all your open positions, your profit, and everything you need to know. So it's kind of at a glance, have a look, where am I? Yeah. So you can go and have a look at that in your own time. Every trade I take follows the same process. Okay, so I get an alert to a condition in the market. I look at the chart to see if this is in the direction of my overall bias or a good mean reversion entry. I see if now is the time to get in, or I think it's got further to go before I enter, like that gap example I just gave you a second ago. I look at my current exposure to see if I can trade this, or I'm on that pair in other trades. So if I get a market condition alert to get into US dollar yen long, and I look at my exposure at the moment, and I've got 2 US dollar trades on at the minute, just won't bother looking at it because I can't take it because I'm already on the US dollar. Okay, so then I either jump in now, or I set up the EA to get me in when the market reverses next. And then I just monitor the Trade Manager dashboard a few times a day to see how things are going. Okay, so trades that need advanced drawdown control are managed as needed. So that's it. I'm literally sitting here waiting for an alert to ping. When an alert pings, I look at the chart. I look at whether I want to get in. If I do, I either take a trade or put the EA on my VPS to take it for me. And then I just monitor my dashboard. Simple as that. Yeah, so I've boiled it down to very, very simple processes. So first strategy, setup number 1, mean reversion. This is my bread and butter strategy. Market exhaustion without profit takes. And you can trade this on M15 or H1. You could trade on M5, but I would recommend a higher time frame than M5. M5 is really scalping. M15 to a certain extent is quite quick. Starting out, try H1. But M15 I found to be the best sort of time frame that filters out the majority of the chop in the market, but also gives you a good enough quality of signal for this particular type of trading that you can make it work. Okay, so mean reversion is where we are expecting either in a range. Let me open the whiteboard actually so I can draw it better. So mean reversion is either in a range of some description. It's not going to look as even and as nice and neat as that, obviously. But the idea is we expect it at least to come back to the middle, the mean. It moves down, comes back, moves down, comes back, moves down, comes back. Most of the time, it will continue like that. Sometimes what will happen is the range will stop being a range. So it'll go like that, go like that, go like that, go like that, and it will break out the top, and then it will go like that. And then it becomes a trend, okay? But it will still revert to a mean. The new mean has just changed to a different thing. Now it's a channel. So we start mean reverting in a channel, okay? So mean reversion is just a way of saying it's going to come back to the middle, yeah? And a lot of the time it will not mean revert, it will completely collapse in the opposite direction, which is absolutely fine. You know, as long as it comes back our way, we don't care. So the tools I use for this are the RSI dashboard and or indicator. So just the RSI indicator if you haven't got an RSI dash, and the market reversal alerts indicator, and the EA, or if you haven't got the EA, you trade it manually, okay? And if you haven't got the market reversal alerts indicator, you could use anything. Like I said, when we're covering the indicators, you could use a bearish engulfing, you could use a 3-bar reversal, candlestick pattern, whatever you want to use as something that's telling you that the market is moving in the opposite direction, okay? But that's what that indicator was designed to do, which is why I use it. So the first thing I do is I wait for an alert that your higher time frame RSI is extended. So this will be above the 68 level or the 70 level or the 80 level, or it will be below the 32, the 30, the 25, the 20, whatever levels of RSI you have decided to use, it will be above or below those. The higher, more extended RSIs you use, the less signals you will get, but the more accurate those entries will likely be. Okay, so you can choose any RSIs you want. So after I've got an alert that the RSI is extended, I then check the H4 chart to see how strong the move has been and if we are due a pullback. Okay, so if the RSI is extended, where we've had a move that has gone like this, yeah, and the RSI has got extended here, that isn't a particularly strong move. It's just a little bit stronger than normal. And there's no reason to say that is not going to come back. More than likely it will. But the best types of these are where the market does something like this. Yeah, so it's a massive strong move and it's parabolic. It's up and it's gone completely crazy. And there was no point where they pulled back. Yeah, so the less they've pulled back when they do that move, the better and the more accurate these entries will be for you. Okay, because everybody that buys has to sell. If we find that there's buying, selling, buying, selling, buying, selling, buying, selling on the way up, there might not be buying and there might not be selling coming in now. It might be more buying. Okay, but if it's buying, selling, buying, selling, buying, selling, buying, 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 and we get an alert, they've got to sell, haven't they? So they need to take profit on this move. Okay, so the whole idea is we are exhausted. There's not been a profit take, which is why I call it market exhaustion without profit takes. That is your ideal. Now, most of the time, if you've done any back testing with RSI since you've been doing this, you'll have noticed that the vast majority of the time when it gets extended on RSI, it just comes back anyway. But the ones that get really extended really fast tend to come back quicker and quite often more aggressively. We'll look at some examples in a minute. So that's what I do. I look at the H4 chart and see, are we due a pullback? Okay. Step 3, is there a level we are about to reach or it has just reached? Support and resistance, or maybe a 1, 2, 3 gap. So has the market pushed up, given us an alert on the RSI, and it's now just hitting or just approaching a level of support and resistance from the past? Yeah, here. So this is a level we couldn't get through and we're unlikely to break through again. So if we've pushed up very hard into that level, brilliant. Or is it a level we've pushed up into once, maybe twice, and now we're coming up here again? Remember what we just discussed. There's going to be orders here. There's going to be pending orders for people that want to take breakout trades. There's going to be stop orders for people that have taken short positions from there. Is the market coming to a level where it's likely to reverse for any reason whatsoever? Are there 1, 2, 3 gaps or propulsion candles as obvious targets? So when we've pushed up hard, has it left propulsion candles and 1, 2, 3 gaps down below to act as magnets, targets for us to reach for? Okay, if yes to all of the above, switch to M15 and get in. Simple as that. But we get in on the next reversal alert. We don't just get in because of that situation, that condition that has been reached doesn't mean we get in. Our signal indicator tells us to get in. Okay, or I put the EA on my chart and I let it get me in when the next reversal alert happens. Again, this is the beauty of using the EA, is if I see RSI extended in this particular type of strategy, I can put the EA on that chart, and if it doesn't give me a reversal alert for the next 2 days, I won't get in. But when it does give me a reversal alert, I'll be in automatically, and I might be asleep. Okay, so that's the reason behind the development of the EA, is to just basically mean I don't have to press that button. It's laziness, but it works. Okay, target. Usually I assume the worst case scenario, that these will only be a pullback trade, okay, a mean reversion or a profit take move on the big move that they've just put in. So I like to see an obvious target no more than 50% of the way into the move. You can use a fib to measure this, and we'll have a look at that in a second. I like to see a good 1, 2, 3 gap or propulsion candle to aim for, ideally before the 50% retracement will be completed. Okay, and considerations: is there any news that has caused this move that may fundamentally change direction? So we've just watched the non-farm payroll event unfolding, and sometimes news will make a massive spike. Now, if news does make a massive spike, that's fine, because what have they got to do after they've been making that massive spike? Take profit on that move that they've made that massive spike with. So you will find news moves will retrace, but sometimes there are fundamental news releases like massive rate changes where it will just spike hard and it will go for days. So just be aware of news. And again, you've got to make sure every morning part of your routine is opening your news calendar. What have we got today? So when you see that big spike and you go, right, that looks like a great opportunity, you know in the back of your mind if there's possibility of a news event that's caused it. Okay, so let's have a look at an example. So this is the 4-hour chart. Now on the previous slide, I said check, wait for an alert on your higher time frame RSI. Okay, and then I've put check H4. The reason I put higher time frame there was to remind me that this is a multi-time frame strategy. Okay, so I personally trade it on H4 and M15. So I use M15 for my signals and my entries, and I use H4 for my extension conditions with RSI. If you want to trade faster, you could use the hourly chart as your RSI and M5 for your entries, or you could use the daily chart as your RSI extensions and your hourly chart for your entries, or your weekly chart and your daily chart, or your 4-hour chart. Okay, so it's multi-time frame. So in this particular example, I'm using H4 and M15 because they're nicely spaced out. So this is the Euro odd H4 sort of at the moment. As you can see, we've got RSI extended on the 4-hour chart. So in this particular case, I've decided to use 70-30. You could use 80-20. You could use 68-32, any you like. But I've decided in this example just to use 30-70. They're a good trigger, a good solid level. So price has moved down. We've extended there. So this is my condition. So my RSI dashboard has gone ping. Okay, we're extended to the downside on H4 on RSI. I go and have a look at the chart. Have we had a big, strong push in one direction? Yes, that's pushed down really hard. We had a little bit of a profit take in the middle, but it's just a big, solid push. Is there any levels of support and resistance? Yes, down here. So there's a good possibility we're going to get a bounce here because it's extended and it's also near a support resistance level, right? Are there any targets above me that I could aim for? Yes, there's loads. Look at these propulsion candles, 1, 2, 3 gaps above me. So there's really, really good opportunity for a trade right now on Euro odd. Okay. So what I do then is I flick down. Sorry, I'll cover next what I do as my backup plan. So the first thing I do after I've looked at the chart on H4 is I put into place a backup plan. Okay. This is an important step before you take a trade. You can take a trade straight away. You can jump in straight away on this type of strategy. But at some point, you need to plan your entry, okay, your additional entries. So remember what we want to happen. We take a trade, it goes to our target, it hits it, we get out. Happy days. That's what we want to happen every time we hit the button. It doesn't happen that way. So what we need to think about is, what if I'm not going to make this trade? Okay, so you need to plan for my additional entries. So what is my backup plan? How far away am I going to space the entries I'm going to get into in my position if this trade doesn't play out for me now? So what I tend to do is look at levels that price is likely to head to next. So let's say, for example, we were getting in today on this one here. The levels I would look at if this doesn't hold if this doesn't act as support, would be ADR or an obvious level of support further down from where we are now. So where's the next level of support? If it's not going to bounce at this support, where's it going to bounce? Probably that one. Yeah. Look how many times it's respected it. I've drawn it on the chart. Yeah. It moved up into it and rejected it. Pushed up, rejected it. Pushed up, consolidated, tried to break through it, couldn't get through it, just struggled. Nope, not having it. Tried again. Nope, not having it. That's a really, really, really strong support. So if this doesn't hold, probably somewhere around here. I don't know when, doesn't have to be to the pip. Let's say somewhere in that block. Doesn't matter, does it? We're not being accurate. We haven't got to time our entries. We need to know roughly, if this doesn't hold, roughly where we're going to go, down there. Okay, so I'm going to plan my entries to get in here and here. So I would then look at what the ADR is on the pair and space my entries out accordingly. So is this level roughly 126 or more away? Yeah, brilliant. Okay, so maybe I'll get into one here and then here. So I'll think about how far away I want to space my entries out. Remember when we looked at ADR and what affects the drawdown on your positions? ADR is one of the key things. The distance between your entries is one of the key things that affects your drawdown. So I would recommend no less than half an ADR between your positions or one ADR. Okay, but have a look at your first entry, measure the distance there and think, right, that's probably, I don't know what that is. Let's say that's 1.5 ADR. So what I would probably say is I'll get in at 3/4 of an ADR apart. So I'll plan to have another couple of entries because by the time we get down to there, we should get a nice bounce, right? If that doesn't hold, where are we going next? Probably down there. Look at that big spike down there. We couldn't get down any further than that last time. And it just happened to be in line with exactly where we struggled to get through last time. Yeah. So that's an area that Price was not happy trading at. It bounced, it couldn't get through it, but it finally got through it and it said, yep, that's fine. Then it tried again and was like, no, we're definitely going up. Okay, massively strong area of support. So entry 1, entry 2, maybe 3, entry 4. If that fails, where are we going next? There's blue sky here. There's nothing between this level of support and really the low here. And this is an obvious one, isn't it? Yeah. So there's nothing there to take. So if we get down to here and it doesn't bounce and we get out of our trade, we're probably going to have to get into positions 5 and 6, spread them out nicely. So the plan is either this trade works and I'm out and then I move on to the next, or I'm going to have to take a position on this and the position will either be that, or that. One of those will play out. And remember, right now, we're extended massively on the RSI. How extended will the RSI be down there? How extended will it be down there? How extended will it be down there? We'll be embedded, won't we? Bang, it's got to have a profit take, because if they push price all the way down there without taking a profit, you can guarantee a V-shaped recovery is coming, because there's going to be so much buying pressure coming back the other way. This is a prime example of the opposite of what could happen there. Pushed up, got extended, and it went, no, going to carry on going. Pushed up, and then bang. That's an A-shaped recovery. In this case, I would be planning a V-shaped recovery. Okay, but we don't know, do we? We can't tell what they're going to do. Nobody knows what they're going to do. We can only play the odds, play our edge, and play what we see in the past. We know in the past, when this thing gets extended down here, it pops. When it gets extended up there, it pops. When it gets extended down there, it pops. We're extended down there. It's going to pop. If it doesn't pop here, it's going to pop there, there, or there. So we plan it, okay? So that's your backup plan. So when you take your first position, you've done your analysis and you go, yeah, this looks like a great trade entry. Let's have a look at where we're going to get in next, okay? And then we get into our entry, all right? So when I was speaking about Fibs a minute ago and looking at the pullbacks on Fibs, so we get in on our entry on M15, which we'll have a look at in a second. But when we're planning our targets, what we've got to do is look at where we're potentially going to be going. All right. And we said, let's look at gaps, right? 1, 2, 3 gaps. So there's plenty of them. We can see them. Okay. There's one here as well. And there's one here. There's one here. We're obviously already at that one, but we would have taken our entry somewhere down here. We'll have a look in a minute where the entry was. So after this pull down, we need to see where we're likely to go. One of two things is going to happen here, isn't it? Price is going to push down and it's going to pull back and it's going to continue. So if we are in a trend, we're red. If we're in a downtrend, we're going to pull back and then we're going to push. Or we're going to pull back and we're doing a V-shaped recovery. One of those two things is going to happen. So we plan for the worst case scenario. Worst case scenario, this is just a pullback, not a reversal. So where's it going to pull back to? So weak pullbacks, you will find, if you use the Fibonacci tool, will tend to be back to the 38 level. Medium strength or strong pullbacks will be back to the 50 level, sometimes 61.8. If we break that level, we're typically doing a V-shaped recovery. Okay, so that's how you can plan your targets. So what I tend to do is I will draw a quick fib on the move, and you'll see here I've drawn 2 fibs. The reason I've drawn 2 fibs is because we've got 2 moves here. One from the high there, you could class that whole thing as one move. And then we've got this little sort of pullback consolidation. So there was a high there, so this could be the move. I'm not sure which it is, and I don't know. So I'll measure both and I'll look at where the fibs are on both. If there's only one obvious move, there's only one measurement to make, isn't there? But if you want to use a fib tool, this is great because what we can do now is find confluence of targets. Here we have a 1, 2, 3 gap. Okay. And it's sitting bang in the middle of the 38 retracement. So that looks like a really good level to target. Failing that, we've got a little one there, but a big one there. So that might be a great target to aim for, and that's the 61.8. So we're either going to have a weak pullback or a strong pullback. So those are where I would be targeting. Also, support and resistance you can use. So look at this low here where we bounced off the 72 moving average. We rejected it a little bit there, and then we broke it. That is a pretty good level of potential resistance. So in a trend, we see price move down, up, down, up, down, up. And what it tends to do is bounce at wherever it stopped on the way down. Yeah. Typical market structure. This is how market structure works. That is that down. So it's likely to do that. Where's that? The 50. What have we got there? 1, 2, 3 gap. Perfect. So that would be my ideal target, would be the 50. So plan for your targets to be worst case scenario. And this is worst case scenario. This is just a pullback. If it's not, it's a V-shaped recovery. Happy days. We're going all the way up there because we've got a target, another target, another target. Yeah. So that's planning your targets. You don't have to use a fib tool. Okay. So if you don't use a fib tool, we've got these on the screen. You can just use those. But if you use fibs or you like fibs or you know how to use fibs, they make a great confluence for additional backup for your plan, if you like, for where you think price is going to go. So then after we've done that, we get in. Reversal alert hits and we can see our targets up there. So where is price likely to get drawn to? Support resistance, 1, 2, 3 gaps. We've got tons and tons and tons of them to aim for. And you saw we put our fib on there. So we would target somewhere we think is obvious. This level here would be of interest to me as well, because we bounced. This is the support I drew on the H4. We pulled back down. We didn't make it back through there. So as we've got through there, there's a chance we might get stuck here, but it's more likely we're going to head somewhere like that. Okay. So this red line here is where we got the signal on H4. So this is where we got extended on the RSI on H4. So this is where we would be now looking to take reversal alerts. And we would have got our first one Yeah, this probably would have been the first one, to be honest. So this is where we would have got in. And obviously then we'd be looking for targets to the upside. Okay, and ideally what we want is our target to be within one ADR, don't we? So the ideal would be to target some target within an ADR away. So here's ADR. This is a bit too close, obviously. This is more of a scalp. But tomorrow, if price is pushed up there, the ADR levels will be redrawn, and these will probably be very much within range. Okay, so that's the first strategy, mean reversion. Okay, so we'll have a quick look at the EA just trading this for us, and we'll see some trades play out. So that it kind of hammers it home what is actually happening. Just looking at what we've got going on with the non-farm payroll. So let's move over to the strategy tester. So I've got some set files set up, kind of ready to go. Let me just load that up. So mean reversion. Okay, so what this is going to do is it's just going to take trades and it's going to use the 4-hour RSI when it gets extended, and we just use 68.32 with the 14 RSI. And that's literally all it's going to do. It's going to take trades and it's just going to target one ADR, or it's going to try and bank roughly 1%. Yeah, so it's going to use one ADR or 1% as a target. And I've put the hybrid martingale on this as well. Okay, so just so we can see that playing out. And that's literally all this is going to do. So let me just set this up, pound US dollar. Just trying to think what date it was. I think it was the 23rd. Just trying to find some good examples that that play out almost straight away, because sometimes you have to wait. Yeah, okay, so let me just pause that. So the RSI was extended just as we got into it. The RSI was extended just below the 32 level. As you can see, it's 31.5. So because we're extended, we took our first entry. So price continues, I think on this one, not sure. I think this one just goes straight to a target. I've got some different examples in here of taking single and multiple exits, I think. So we've gone straight into a consolidation at the moment. So we've pushed down and we're consolidating. So you think of how that's looking on a chart, it'd be something like that. And then we'll wait for that reversal of that move to start. Okay, so there's our target hit on that trade. Now we've pushed up. We're not quite extended on the RSI, so we won't be taking any trades at the moment. We're waiting for this RSI here to get above the 68 level, and then we will start looking for short positions. Then gone into another consolidation at the moment. Now we've pushed up, RSI is at 63, not quite where we want it to be, not quite strong enough push. There we go, we're above the 68 level now, so we've just taken our short trade. There's a good example of enticing people to go short. Everybody's gone short. They've put their stop orders up there. So they've come up and they've taken that liquidity to power up their next move. I'm going to continue to push up a little bit higher. See, we're still extended on the RSI. We're still up at the 70 odd level. Move down a little bit now. We're still in a big consolidation at the moment. If you look at this, just kind of sitting, waiting at the minute. So we're going to get another push shortly. which is going to take price higher. And then we're going to enter our second position. If it ever gets out of this consolidation, there we go. Okay, so we've pushed up high again, taken our second position as the overnight changeover happened. So our average price is now somewhere there in the middle. So we've taken one position, got our second position there. So it'd be a little bit higher because we're taking a slightly larger lot size on this one. We're extended on the RSI. We're above the 70 level now. So we've had a good, strong, hard push to the upside. We're just waiting for them to put that sell move, that profit taking move in, which is just coming now, and then we're out of that position. So we've taken those two positions off. We've taken one off at break even, this one in profit. So this one basically pays for that one and we get out. Okay. So that is basically how the mean reversion strategy works. It's very, very, very simple. We're literally waiting for the 4-hour RSI to get to a condition of extended. We're having a look at the chart, seeing if it's a trade that we want to take, seeing if there's been any kind of massive profit taking move. If there hasn't, then it's probably going to be playing out very shortly. We drop down to our lower time frame. We make sure there's targets above that are obvious for us to reach for. We enter when we get a reversal alert, and we take profit when that move happens. When they take their profit, we take ours. Okay, and if we need to, we get in at additional levels below. So the EA in this case, obviously, because the EA cannot see 1, 2, 3 gaps, and it cannot see support and resistance, the EA will simply get you in at ADR extensions. All right. So in this case, we've set the EA to use half an ADR. So it will say when we push half an ADR or more away and get another reversal alert, take a position. And that's why I was saying it's important that you measure where the next support resistance levels coming up are, because if the first one fails, it's likely the second one will hold. So if that second one is two ADR away, you probably only want to place your trades at least 1 ADR apart. All right. So any questions on that? The mean reversion strategy. Does it all make sense? Everybody understand the process? Again, you can go back and watch this, obviously, again, and refresh yourself with the rules, but very simple rules, mainly based on RSI extensions on the higher time frame, entering on the lower time frame, targeting where we think it's going to get attracted to as a magnet when the market uses puts in its move. So TP is 1 times ADR. No, TP is usually a gap, a 1, 2, 3 gap propulsion candle, or 1 ADR if you want to. Yeah, you can target 1 ADR. Targets are up to you. With the EA, I have that set up to 1 ADR, but you could use half an ADR. Yeah, the smaller your target, the faster you will get out. But if you target more than 1 ADR, you're going to find it more difficult to escape your positions, because when price moves hard in the opposite direction, it will tend to put in a 1 ADR move or thereabouts. If you target 2 ADR up here somewhere, and we covered this yesterday, what could happen is it could just do that, and then you've not got out. You've missed your escape. Yeah. So that's the reasoning behind it. Remember, assume worst case scenario. Assume that this is just going to be a pullback. So big selling move, profit take, pullback. We just want to get out on this pullback. We don't want to get greedy. We're not going to target 3 or 4 times ADR. It may well do that. And if it does, brilliant. But if it doesn't, think about your drawdown. We're just getting out when the market lets us out, because the market's got to breathe. The market's got to get out. So we get out with it. Yeah. Okay, so that's mean reversion. For the EA demo, do you have it set to sell only mode? No, that was buy and sell. It's based on H4, that particular one. I mean, obviously you could use hourly, M5, H4, M15, daily, hourly, whatever you want to use. But the higher time frame, when the higher time frame gets extended, that's when we get in. So I don't care which way it is. If they do a load of massive sells, I'll get in long. If they do a massive buy, I'll get in short. Doesn't matter which way they go, does it? We want to get in when it's extended so that we can get out when they put their profit take moves in. You said yesterday 1, 2, 3 gap indicator you started using later. What target method you use initially, ADR or Fib? I used a combination of Fib and ADR, both, basically. Well guessed. And support and resistance, obviously. Support and resistance. If price pushes down here, and let's say it gets down to here and it's going to pull back, if it does one strong move all the way down to here, you'd be looking at support and resistance levels. So if it did that, this is the bounce point. Boing. Yeah, it's going to come back to that. Price is attracted to 1, 2, 3 gaps, propulsion candles, and support and resistance levels. Yeah, it hits resistance, it tries again, it tries again. It's being attracted to this like a magnet. Yeah, it pushed through it. Look what happened when it pushed through it. It got attracted to it like a magnet again and again. Support and resistance is support and resistance because these are the magnetized levels that price wants to go to, because there's liquidity there, there's buyers and sellers, equilibrium. Some people call it balance. Yeah, this is what's called an area of balance. We call it consolidation, don't we? People are happy to trade here. And if people are happy to trade there, it will continue trading there until someone goes, I'm not happy trading here. And everyone goes, I am. And they go, no, actually, we're not. And then we get a breakout. So consolidation is just a period where the market participants, the big banks, the institutions are happy to exchange orders at a level, a price range. That's why we call it a range. It's a range that people are happy to trade in, a balanced economy, a balanced pair, a balanced, whatever you want to call it. That's what it is. When we break out of it, it's not balanced anymore, and it's not a range anymore. It's now probably a trend. Okay. And as we trend and we get to a point where everyone goes, actually, I'm not happy buying up here anymore, we come down and then we come up and we see, are you happy buying here still? No? Oh, okay, fine. You said you were happy buying there. Yeah, but I'm not. Support. That's all it is. It's an area that people are happy to transact at. Richard's just asked, I'm working 9 to 6 job. What strategy could you suggest? If you're using the EA, any strategy you like, because you can set the EA up to automate the vast majority of this. If you're trading manually, you need to be really trading H4. So I would suggest probably daily and hourly, because your higher time frame, basically with your higher time frame, whichever higher time frame you use for mean reversion trading, if you use the H4 chart, you need to check H4 every 4 hours for the extended condition. So we're looking for RSI to be extended every time a candle closes. So if you're trading H4, you need to check this every 4 hours to see if we're above here or below here. If you're trading the daily chart, you need to check it every day, once a day in the evening. Get home from work at 6 o'clock, have your dinner. While you got your dinner, you stick your laptop on and you whiz through all the daily charts. What have you got extended? Oh, excellent, that's extended. I'll flick down to the hourly chart and I'll take a reversal alert. Yeah. If you want to trade M5 and hourly, you've got to be checking your chart every hour. Every hour you need to see, is it extended on the hourly? And that's why I built the dashboard. Because the dashboard, I don't have to check that chart. I don't have to do that check anymore. The RSI dashboard sits there and it goes, ping, we're extended. And I go, oh, I'll have a look at that. I don't have to check it. If it doesn't ping at me, I don't look at it. And we have periods where it does this. Summer months, the market, quite often the summer months, is so quiet. the RSI dash doesn't ping, doesn't light up. It's just blank. So I don't trade because there's nothing to trade. You can't take a mean reversion trade if there's no extension, because there's no mean to trade back to. Yeah. So pick the time frame that suits you. We covered time frames one of the days. I can't remember which day it was. It's all melting into one. One day this week we covered the time frames to trade, and I would recommend M5 for entry, H1 for higher time frame, M15 for entry, H4 for higher time frame, H1 for entry, and daily for higher time frame. So those would be the ones I would typically recommend. If you want to trade daily entries, you kind of need to be using the monthly, really. And you'll find it incredibly slow. That's more of an investment time frame, and you would get in with larger positioning size typically there. So, okay. I bet most of us in the same position, so looking to automate as much as possible. Yeah, and that's partly why I built the EA. I'm not in front of my charts all the time either. So if I see something getting extended on the 4 hour and it's getting close, so let's say, for example, I was looking through the charts and I saw this condition here. I saw this down here. And it hadn't hit the level, hadn't hit the 30, but it was getting close here. What I might do is stick the EA on and say to the EA, when H4 gets extended below 30, okay, take the next reversal alert. If it doesn't, and it does what it did, and it just bounced, I wouldn't get in the trade, would I? And then I'd look at it the next day and go, oh, it didn't work out. Take the EA off. Done. And this is what I mean by semi-automation. Rather than what everybody tries to do with EAs is they buy an EA, they stick it on every pair, and they want to go and sit on a beach and not do anything and make that thing make money for them. It's very, very few EAs that will ever do that, if any. What EAs can be used for is exactly what I just explained. Is semi-automation, but I still need to be in front of these charts watching it because it's my money at stake. I'm not going to let that thing run my entire trading life, but I can let it automate 90% of it so that it can do the heavy lifting for me. But if something pushes against me, I'm still going to need to do drawdown control. I still might need to act advanced drawdown control. So there's all sorts of things I have to do, but the EA will automate as much as possible. But if you can't use an EA, you have to trade the timeframes that you can use. And if you are working 9 to 5, you can't trade hourly and M5 or 4 hour and M15. You could possibly get away with daily and hourly. That's where I'd try. Yeah. Okay. Day 2, someone's just said whatever. Yeah, that's fine. All right. So that is that one. So let's knock that one on the head. You can come back and watch that. If you've got any questions, obviously you can ask again in the Telegram group. We will have a Q&A at the end of the session as well. Okay, next setup, trend pullback continuations. This is a variation of mean reversion. So this is very similar to what we have just looked at, but we are only going to take trades in line with the trend. So these will tend to quite often have less drawdown. But you will also have less entries because you'll find that you won't have as many that you can find because the market ranges 80% of the time. It isn't trending as much. So the trend pullback continuations, you tend to find less of them, but you will often always find as well that they are mean reversion alerts as well. So your mean reversion alerts, if you like, that are in line with the current daily trend, if there is one, this is what this is. So again, M15 H1 entries are ideal. I wouldn't go lower than that. You can use hourly for higher time frame analysis in M5, but obviously you're going to get more chop doing that. So M15 and H1 is perfect. Tools, same as before, RSI dashboard and or indicator, market reversal alerts, indicator, stroke EA, and obviously we're going to be using our moving averages, the 24 and the 72 moving averages. So step one, we wait for an alert at 4-hour RSI. And again, I'm using H4 M15 in this example to get above or below the 50 level. Okay, so the difference here is we don't have to wait for it to get really, really extended because we're expecting a trend continuation to happen. So with these ones, we can use the 50 level of the RSI, but that is for an aggressive entry. I would suggest initially that you use either 60-40 or the normal 70-30, 80-20, whichever you choose, but those are your conservative entries. So these are the safer ones. And I'll explain that in a minute. Step two, we check H4 to see if we are in a nice trend or we are looking like we are just starting one, right? So we'll get an alert from our RSI that a condition is met, i.e. we have hit a specific level. We then check the chart to see if we've got a nice trend in place. If there's a nice trend in place, brilliant. If there's not, we ignore it. We are pulling, step three is are we pulling back nicely to the 24 or the 72 EMA? Okay, so because this is a trend pullback continuation, we are getting in when we've got some kind of trend started and we are pulling back. So this here is where we are looking to get in, assuming the trend continues. So these are the pullbacks. Yeah. So this is what trend traders trade all the time, is the pullbacks. So we wait for the pullback. We can use the 72 or the 24 though, because we're position trading. If the 24 doesn't hold, as we discussed, most of the time, the 72 will. So if we get in when we're pulling back to the 24, there's a high probability of that trade working. If that doesn't work, the likelihood is it's going to pull back to the 72 and then the profit take move will start, either the trend continuation or at least a pullback. So we get 2 bites of the cherry. So are we pulling back to the 24, the 72 EMA right now? If yes, switch to M15 or H1, depending on what time frames you're trading, and you get in on the next reversal alert. Or same as before, put the EA on the chart and let it get in for me. Targets, I usually aim for 1 ADR move on these. So the reason I normally use 1 ADR with these is because if we are assuming we're going to get a trend pullback continuation, i.e. the trend is pulling back and is going to continue, 1 ADR is very achievable. Quite often with these, you will get a much bigger move. You'll get 2 ADR, 3 ADR, possibly more, if you want to hold on for them. And you can take a partial profit on these if you wanted to. So you could get into a position with, say, a 0.02, 1 ADR, take a 0.1 off, put a break-even stop on and let the rest go. But you know what happens to break-even stops? They get stopped out. So it's entirely up to you what you do with it. But trend continuations, if we are going to continue the trend that we're expecting, quite often it will go a lot further. But I aim for 1 ADR because I'm not greedy. I want to get in, I want to get out, I want to put that profit in the bank. I want it banked in my P&L so I can move on to the next opportunity and not tie up my exposure. Because remember, when I enter this trend continuation trade on US dollar yen, that's $1 US and 1 yen, I can't trade again. So I want to be in and out and get the next opportunity that comes up. And ideally, I want to be in and out within a day or so with these, because if it's a trend continuation, quite often those bounces happen and they happen quite fast. So you're in and out. Ideally as well, if you've got a good 1, 2, 3 gap or propulsion candle above you or a support and resistance level that's obvious, use that as a target. And if that's 1 ADR apart, brilliant, perfect target. So the considerations for this are we potentially coming to the end of a long trend. So if you get an alert and this thing has been trending for 4 weeks, yeah, and we've just pulled back again to the 24, you have to think to yourself at some point, all good things come to an end. This trend has got to at some point end. Why? Because this is just one big buying move, isn't it? After a big buying move, we get a selling move. Okay, so you have to look at the size of the trend that you've got as well. But if that doesn't happen, if that trend doesn't continue, and this is the end of the trend, we're going to pull back to the 72 probably and bounce from there. So again, we've got that buffer. This is why we use those 2 moving averages. So ideally, we are just about to hit the 24 or are positioned between the 24 and the 72. And I'll show you that on a chart in a second. Is there an obvious target below to aim for in the form of 1, 2, 3 gaps propulsion candles? I don't like to see targets below me. I like to see targets above me if I'm taking a long. Yeah, so I'm assuming that we're taking a long here. We're pulling back. If there's propulsion candles here and I'm trying to get in long there, again, quite possibly they're going to come all the way down here, aren't they? So I might wait until we get there, and then hopefully that will be the move. Okay, and I don't like to see new market structure formed or a lot of gaps in the opposite direction, which is just kind of explained. So let's have a look at that on a chart. This is a trend. Okay, and this is what I mean by a trend coming to an end. The trend is designated by, obviously, it's all green. Yeah, as long as it's green, it's in an uptrend. We're looking to go long. When that stops, we go into a downtrend. Okay, so if we've got loads and loads and loads and loads and loads of green on the chart, if you zoom out and it's just green all the way, go and look at the S&P 500 if you want to see what green all the way looks like. There's a possibility we might be coming to the end of a trend. Okay, but it's the same principle as the mean reversion. What we're looking for is a bounce. Yeah, we're looking for it to bounce off either the 24 or the 72. Yeah, that's what we're looking for when we're in a trend. So we wait for the RSI to get extended below a level. In this case, I've got all of them drawn on the chart. So you can see 50, 40, 30, 20. The deeper the pullback, the more likely the bounce. Okay, so you can see here with some of these, when you get below the 50 level, it still comes down further. When you get down to sort of the 30 level and it's interacting with the 24, perfect. Pull back down again, nice strong pullback. We pulled back down to the 30 again, nice strong pullback. We got down below the 50 there and it continued down below. Now, this is where I said about we are either coming down and approaching the 24, or we are below the 24 and above the 72. So this zone here, where we are below 1 but above 1, that is also a great spot to take trades because quite often it will pull back. It's just a deeper pullback before the move. You see here is a great example of the 72 bounce, the 24 bounce failing, the 72 then supporting price. Okay, so we get in, we expect the bounce doesn't come, we scale in down to the 72, waiting for the move, then we escape. Right, so that's exactly what we're looking for. It's exactly the same thing as a mean reversion, but we are saying I'm only taking mean reversion trades in line with the trend, and I want to take the bounce off the 24, the 70s too. So I'm assuming here that we are going to continue to hold the 24 moving average on the daily. All right. So this is the H1 chart. I've chosen the H1 chart in this case, just to demonstrate where those levels are, because it's easier to get them on the screen, where we got extended on the RSI. Yeah, these levels here, those are drawn on the chart on the hourly here. So you can see, obviously, when the RSI got extended below 40 in this case, we pulled down at that red line, and then we pushed up. Then again, we pulled down at that red line, consolidated for about a week, and then we pulled down and pushed up. And then we came down to here, and again, it pushed down, and then it pushed up again from there. This was a 72 bounce. Okay, so you wait for reversal alerts on your lower time frame, which is either M15 or, in this case, on the hourly. You can really trade either of them with this, because remember, the moving averages we're using are the daily. But if I'm using H4 for my extensions, I tend to use M15. The only reason I've used H1 in this case to demonstrate it is because you can't fit all of those on an M15 chart on one screen. But imagine if you zoom down into M15, the reversal alerts are going to come roughly the same place as they would on the hourly charts. Okay, so the same rules apply for targets when we get in. So here I've drawn where the reversal alert would have been after this extension on H4. We've got a gap there and a gap there. Those are the targets I would have aimed for. And obviously we've got a resistance line there. So where price was pushed up and moved back from, that is a resistance. We were resistive there. We've pulled away from it. So price is either going to come to fill this in, this 1, 2, 3 gap propulsion candle, or it's going to fill that in, or it's going to bounce off of support potentially. So when we're getting in, those are where we should be targeting. And obviously you could also draw a fib and look at where the 38, the 50, and the 68 retracements are. And you'll find that one would have been virtually a 50. So that would have been a perfect target. If it's enough, if it's an ADR. If it's an ADR is there, that would be a target, right? Okay, so that's targeting. Same rules apply with also a backup plan. Yeah, so I'm planning to get in here. If it fails, where are we likely to get in next? Obvious, you're going to go for the 72. Yeah, so you measure the distance there and say, right, that is an ADR apart, for example, it's 126 pips. So you either get in half an ADR or an ADR between positions. So if that was 126 pips, I could probably go 1 ADR apart. I'd enter 126 pips apart, and then all I need is that sort of move to get me out. We're up to there for a nice profit. Okay, and if the 72 was to fail, for example, if this had failed and it pushed down, then you're going to need to look for support resistance. Okay, so there's a good example actually here. You know, you can see here, this is an example of when the trend is coming to an end. You can see it's just like fizzling. Yeah, we've bounced off the 24 nicely. We've come to hit the 72. The fact that we've hit the 72 means the trend is weakening because it's pulled all the way back down here. We broke back above it, but we didn't really get anywhere before we came back down to the 72. So there was hardly any movement. And this is what I mean by I don't like to see new market structure forming. High, low, high, low. Okay, so this didn't manage to get higher than there. So the market structure is obviously shifting the other way. So that for me is a trend over. So when we pull back down to here, I would probably not be looking to take a trade. But when we got down to here, I would be happy to take a mean reversion trade. All right, so that's that one. Let's have a quick look at the EA taking trades for us on that. So again, I've got a little set file which will show some examples of the trend pullbacks. Going back further on this one. Okay, so we'll start that off. So the first entry, I think, is straight away on this one. Very similar to previously. So we've got the, let me just pause 1 second. So we've just taken our first entry there. So you can see here on the, because we can't see the daily moving average, the MA for the daily is at 130.778. So that's the moving average for the daily, the 72 moving average is way down there. Okay, so what we're saying is I want to take long positions when we get extended on the 4-hour RSI below the 60 level, but we are above the 72, i.e. we are pulling back towards the moving average and the H4 has got extended to the downside. Then I want you to start taking long positions for me. So it's just replicating what I've just shown you. So the daily moving average is below us. The 4-hour RSI is below 40, and that's the trigger that I've used. So I've said enter on M15 when those conditions are met, which is why it's taken that initial trade. So the same principle applies. We're looking for 1 ADR target on this. So the first entry is obviously taken. I think it takes 2 more entries on this example. So basically price pushes down into the 72 moving average, and then it bounces off the 72 in this particular example. So we'll just let this play out. Second entry taken there, we had a reversal alert there. So your average is now sitting somewhere around there. We're continuing to push down towards the 72. So there's more and more selling pressure coming in. Again, we've gone into a consolidation for a few days. And this is what I mean, you know, when I keep saying the market consolidates 80% of the time, this is what we do the majority of the time, which is why mean reversion strategies work. And obviously we're on a very low time frame here on M15. So it's a low time frame we're looking at. So we're seeing a lot more chop than we would if we were trading the hourly charts, which are obviously going to be a lot cleaner. So we pushed down and we've taken a third entry on that one there. So our average is going to be somewhere around there. Okay, so on the 4 hour, we will have been pushing down and down and down. We've hit the 72 moving average, which has been coming up to meet us. And now we're bouncing off the 72. And there we go, we've hit our target of 1 ADR. So the total of those 3 positions is 1 ADR in profit. So it's taken the whole thing off. I think there is another trade which happens around the 17th from memory. But that I think is just, it gets in with 1 position. So what we've done here is we've bounced off the 72 moving average. We've pushed back up above the 24. And what it does is it pushes back down to the 24 and bounces again off the 24. So we're going to get a pullback. I think it's here it enters. There we go. So the moving average on the daily is 131,279. So it's somewhere down here, just around there is where the moving average is. It's the 72. We've pulled down below the 40 level on the RSI. And then we've started to bounce. So it's taken its entry. And then I think we're going to a consolidation for a few days here while we're waiting for the move to continue. So obviously this is a continuation of a trend. So we've bounced nicely off the 72. Now we're bouncing off the 24. And we're just going to continue on our trend. Sorry, it takes another position there. There we go. We're out on those 2. Okay. So held that position for a few days. So we bounced back down again off the 24 and took a profit. Okay. So that's basically trend pullbacks. Any questions on those? All makes sense. So it basically is the same as mean reversion. But it's for people that want to trend trade more. And they, as I say, you tend to get into less positions because the trend will always try to continue. When you see a trend happening, because something is trending, the market will want to continue that trend and it will resist coming down because there is a lot more buying pressure than there is selling pressure. And that is why we're trending. So when the pullbacks are deep and they happen, you tend to get those buyers stepping in because all that is a profit take on the buyers before they continue their buying move. Okay, but all trends have got to come to an end at some point. So that's trend continuation. Now we're going to look at a couple of scalping strategies as well now. Okay, so the third one is ADR reversals or scalps. And these tend to be M5 entries. Okay, so these are using the ADR reversal indicator or an ADR indicator of some description and or the dashboard. Okay, and obviously I use the dash because I can sit here all day doing absolutely nothing and waiting for the ADR dash to ping at me. And when it does, I'll go and have a look. And you can use the market reversal alerts indicator or EA to get into the trades. Okay, so you need some signal indicator when ADR gets extended to tell you to get into a trade. So the first step on this, very simple. We wait for an alert that ADR is hit. So we know obviously price has an average daily range. It stays within that average daily range around about 58% of the time. When it exceeds that average daily range, it is an abnormal move. And therefore, if it's pushed that hard, there tends to be a profit take move happening after it. A lot of times you will find these happening on breakouts. So you will find that the market will be sitting in a range for a while. Okay. And sometimes what will happen is it will push out of that range. Okay. And you know why it's doing that. We've explained it. I'm not going to explain it again. And then it will pull back into that range. And to do that move, it needs to push harder than normal, which takes price beyond its average daily range. And then they move it back. And that is why ADR works so well. The other thing that happens with breakouts and ADR is you'll be sitting in a range and the breakout will actually work. It will break out, pull back, and you will start to trend. But even if it breaks out, what tends to happen is at some point you're going to pull back, because for the buyers to push price that far out of a range, they get exhausted and they need to take profit before they continue that additional move. So if price pushes out and we do get a breakout, you'll get that move continuing. And sometimes you will find that it will break out hard and then it will just consolidate for a little bit, push higher, and then you will get the profit take move. So sometimes you have to wait for ADRs to play out over a period of 2 to 3 days before that move happens. But quite often you will find they happen when you're in a range. Now, if they happen within a trend, i.e. we're trending up like this, okay, and we get an ADR hit to the high, I usually don't take those because we're trending in that direction. I always like to, if possible, be in line with the overall daily trend. So if ADR hits to the downside, those trades I would like to take. All right. So I wait for an ADR alert to hit. I check my current directional bias on that pair. Do I want to get in? Are we in line with the current trend? Are we range bound? Is this likely to come back down? So I have a look at a higher time frame really and decide whether or not this looks like it's coming to a support resistance level that it's likely to bounce from. Is it a breakout happening, or are we in line with the trend and this is pushing hard in line with the trend? If it is, I'm not really interested in getting into it. I check H4 RSI level, and basically I need to see if that is nicely set up as well. So with the H4 RSI, I want to know if we're in an area that we're likely to bounce from. So for example, let's say ADR hits low. So we've got the 100% ADR line there. We'll look at an example in a second. And we've hit the low, okay? And the H4 RSI is also down below the 30 level, okay? So not only have we hit ADR and likely to bounce, we are also extended on the H4 RSI. So that's an additional reason for me to get into that trade. If the RSI is fairly high, i.e. the RSI is kind of up at the, say, 52 level, just above the middle, I'm probably not going to want to take this trade, because what that signifies is we've probably come up and we're pushing down. Yeah. So I check the H4 level to see if I'm in an area that is set up to go in my direction, i.e. are we likely to bounce? Is the elastic band stretched? If yes, I switch to M5 and I get in on the next reversal alert, or again, put the EA on the chart and just let that get in and trade it for me. Target for these, because they are scalps and we're on the M5 time frame, I'm aiming for a quarter to a half of an ADR move. Okay, that's the ideal. And I want to be in and out within 24 hours, ideally. Okay. And again, we want to look for good 1, 2, 3 gaps, propulsion candles to aim for, which are caused ideally by this ADR move. So when prices push down hard and manage to get you to hit the ADR extension, we would love to see a propulsion candle causing it. So a big move somewhere where we've got a target that they are likely to be drawn back to as a magnet. Yeah. And then when we get our alert, we look and see if that is within a quarter to a half of an ADR. If it is, it's a good trade opportunity. Considerations. Is there an obvious support and resistance where we are reaching to now? Same as usual. We look at our chart, we have a look to the left and we say, yeah, there's a support level here. Looks like we're bouncing from it. Perfect. Another confluence, another reason to get in. Is there any news that has caused this move that may fundamentally change direction? You will find on big news events that you will get things moving 200, 300% ADR. If they move that far, there's probably a reason for it. And it might be that there's an interest rate change or some economic factor that is making the market change direction. In that case, we want to be a bit careful. And is there an obvious target to aim for in the form of 1, 2, 3 gap or propulsion candle? So here's an example from the EA. So I've just taken a screenshot of the EA actually taking one of these trades. So you can see here we're nicely extended above H4 on the RSI. We're above the 80 level. Okay. Price pushes above the 100% ADR extension. Okay. If you want to be more conservative, again, we looked at this, didn't we? Move conservative entries. Your more conservative entries can be 125 or 150. Okay. So in this case, we pushed up, we hit the 100 level, but the first reversal alert we got on M5 was way above 150. So there's a nice entry. Our target is 1/4 of an ADR, which is here, or half an ADR, which is here. 1/4 of an ADR is obviously a lot easier to hit than half an ADR. But look at where price is likely to pull back to at some point. This is an obvious level of probably support where we'd probably come back to. But just target 1/4 to 1/2 of an ADR. So this is the trade after it played out. That's where we got in. Okay. The 1/4 of an ADR target was hit the same day. Yeah. So this is where we got in to the trade. We had that candle down there. And then we pushed down and we hit 1/4 of an ADR on the same day. Okay. But if you'd have targeted half an ADR, you'd have to wait until the next day. All right. So obviously it depends on your sort of level of greed, if you like. But these are scalp trades. So they're designed to be in and out fast. So these are positions obviously which can also go against you. So you need to be aware of that. So the same rules apply for a backup plan in case things go wrong. Okay, so you look at where, if this ADR reversal is not going to work out, where are we likely to be heading to next? Where's the nearest support and resistance level? Is there 1, 2, 3 gaps above me that they may be trying to get to? The price may be magnetized towards. All right. So the same rules apply with this, but it's a very, very, very simple strategy. You are literally waiting for price to push harder than the average move today, and then you are looking to play the pullback move on it. So we're just saying when you've pushed up, you are going to profit take, because everybody that's bought here is starting to sell. Okay. And most of the time, within 24 hours, the 1/4 of ADR target will be hit, if not the same day. A lot of the time as well, you will find half an ADR is hit within the day. And if this is a move where they are reaching for a level, remember I said, are they reaching for a level that you can see on your chart? So like a support and resistance, they might be trying to put in a double top move. Yeah. You will often find they will reverse completely, and they will be the final move before a big reversal starts. So there's lots of good reasons to take ADR reversals, but bear in mind, they are also potentially positions you will need to get into and add additional positions to, because they don't always work. It can just be a strong push on a breakout. Like I say, if that was the level for breakouts, everybody had their pending orders here for their breakouts. It did break out and it pushed. So now we've got momentum to the upside and we're looking to do a trend. So it might push up for a couple of days, a couple of hours, we don't know, but it might continue to push on a trend before it puts in its pullback. We just need to make sure that we are getting into the position as normal with spacing that allows us to get out of that trade. So spacing on these, I would normally go with half an ADR. Some people are trading these with 1/4 of an ADR between them. And the reason they use a 1/4 of an ADR is because obviously the ADR is set up with 25% increments, 1/4 of an ADR. So it's very unlikely price will push above 200% ADR. So if you get in at 50% ADR and it pushes up above 175, you could take another trade very quick. Your average is there. So you literally need one candle to get out. Remember, we're scalping low time frames. A 10-minute move can get you out. You know, a half-hour move can make you a very nice profit. We're scalping. So we don't need, let's say this was an ADR hit and we got in here. If we'd have entered our second position up here, look at the profit. They can be massively profitable. And some people also use these with a stop loss strategy. Okay, so these are position trading strategies, but you can use these with a stop loss. A lot of people are using ADR reversals, and this is a strategy I've taught in the past and I've used in the past a lot of the time, where you enter your first reversal alert and you will put a stop at the 200% level. Okay, because we know it's rare that price gets up to 200%. And you'll put additional entries at 175 or 200 or whichever you want to use. So let's say you hit 100, you'd put additional entries at those levels and scale in with a stop loss at 200. So you can use this as a traditional stop loss strategy as well. But obviously, we know what happens with stops. You get stopped out. Okay, sometimes they work, sometimes they won't. But because we're getting in exhaustion, they quite often will work the same day or the day after. So let's have a quick look at the EA again, taking some ADR reversal trades for us. So I've got an ADR set file ready to go, ADR reversals, and this is just getting into positions, and we're just using an aggressive filter on this one. So we are entering when price gets to 100% ADR. Just change the color of that to green or teal, doesn't matter, either or. And we are targeting half an ADR. So we're going with a decent profit target rather than a quarter. So we're being a little bit more aggressive with our entries. We're getting in quickly at 100% ADR and we're targeting a half an ADR move. All right, so let's let this run. I think the date on this one was the 8th. Again, just looking to find entries quickly, because sometimes you will sit there for days and days and days and not find them. So I found some time frames where actually we got into some quickly, so we're not sitting there watching this tick away for days on end. Okay, so let me let this go. So you can see the ADR here is 80 on this particular pair at the moment on the pound US dollar. So we get a push today, oops, all the way up. So you can see the ADR levels adjusting as price pushes up, because it measures from the high to 100% of ADR. Okay, and it measures from the low up to 100% ADR. So we get a bit of a push this day up to the highs, and this is the one that pushes up to 150. We get our first reversal alert here. So the beauty of using the reversal alert indicator is that you don't get in at 100% ADR just because it's hit 100% ADR. You get in when the signs of weakness starting to come in. And this is what this is showing you. It's showing you that price has pushed back down. So this could be the start of the reversal. So we've pushed up and we didn't actually take an entry until almost 150 ADR. So it's getting us in a little bit later. So I'll zoom in a little bit because it speeds up slightly when you zoom in. So on this particular case, it was a breakout. So price consolidated when it got there. There's two things that will happen. It will either break out and consolidate, or it will break out and it will pull back. Okay, in this particular case, we broke out and we consolidated, but we pulled back enough to get out of a quarter of an ADR. If we'd have been targeting a quarter of an ADR, we'd have been out virtually we would have been out the same day. But as it happened with this one, it went into consolidation on the next day, and then they put in a further down move on the following day. So this is the one we just saw the screenshot of. Basically, we're going to push down and approach 100% ADR, and we're going to get out at half an ADR in profit. There we go. So in and out within 24 hours, or just around about 24 hours in that case. That's a typical ADR trade. I'll let this play on because we get a second entry here, and this is an example of one that doesn't work, which is why I wanted to show you as well. So on this one, we get into an entry as we push hard. So we hit 100% ADR again. But on this one, we need to take multiple entries as price continues to push. So remember I said this was a breakout. Yeah. So remember our range. What we just traded was the initial breakout and pullback. Okay. Now the breakout is continuing into a trend. So we've pushed hard again. We're pushing off into our trend now. We've hit ADR. So we've taken our first position, and this is now in a trend. So we're now trading counter trend. So we've pushed up, hit ADR, taken a position and we are continuing to push. So the EA is set to take positions at the moment, 1/4 ADR apart. So it's getting in aggressively. So this is a 25 pips apart on that position. Consolidated for the rest of the day, moved into the third day, or second day in this case rather. Pushing up a little bit further again. And remember, we haven't taken profit on any of this move. It's just been buyers, 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 buyers. And now the sellers start to come in. You see, we took another alert as the selling pressure started and we exited all 3 of those positions. So that trade again, we were in and out within 24 hours, taking 3 positions. So we scaled in and scalped back out of the position. All right. So the nice thing about these ADRs is because you are getting in on a daily strong push, the move has already happened. The buyers are already in. So these buyers now, the entire day's worth of buyers are all sitting there needing to hit the opposite direction button. Okay. And even if we go into a consolidation the next day and then another buying push, we now have 2 days worth of buyers sitting there waiting to press the sell button. So the sell move tends to come in a lot faster and harder, as you saw there. So literally within half an hour, we'd undone pretty much a day's move. And obviously then it continued to push back down further. So this is the selling move off of this big buying move. Okay. So that's ADR reversals. Very, very, very simple strategy. Literally, it hits ADR if it's in line with the current trend, or on the 4-hour chart, it's extended, we get in. Okay, very, very easy. Anybody got any questions on those ADR reversals? I think a few of you may have been trading those already because a lot of people have bought the ADR reversal indicator, and the stop loss version of that strategy is brilliant. I traded that for a long time. Works very well. But trading without stops works even better. As you just said, you get in, you get out very, very quickly. They're beautiful scalp trades. But be aware, obviously, if you get in too quick, you may have to get into drawdown control faster as well, because if you're getting in fast with positions close together and you get a 3 to 5 day push happening at the same time, you do run the risk of going into drawdown and needing to do advanced drawdown control. But the amount of ADRs that will get you into that compared to the amount that will get you in and out within 24 hours will far outweigh the drawdown control you have to do. So as long as you're banking regularly, you'll be fine with those. Okay, so that's ADR reversals. Setup for hedging. We looked at hedging yesterday. Hedging can be done on any time frame. The higher the time frame, the less entries, the less drawdown. The lower the time frame, the more dangerous this is. Okay, so hedging is a more risky strategy, and you need to make sure that you space your positions out nicely with ADR, at least an ADR apart. Half an ADR with hedging is doable if you're not going to use any kind of martingale or hybrid martingale system. If you're going to use anything like that, you need to be spacing out at least an ADR apart, okay? Because you're not going to be getting into these positions necessarily when a higher time frame is extended, because hedging doesn't use a higher time frame analysis. Okay, so it is a more risky strategy. Remember, going back to our strategy, what a strategy consists of, you've got different indicators and levels, but when we're using higher time frame analysis along with all of those parts of a strategy, it's much more effective because we're getting in when the higher time frame is extended, when a move has been extended and pushed on a higher time frame on a low time frame. So it gives us our kind of close entry on the higher time frames push, which means that we're a lot more likely to get out of it faster. So hedging doesn't have that high time frame analysis. Okay, so it is a little bit more risky, but it's also incredibly rewarding because you bank profit constantly. Every single day you will be banking profit with it, and you deal with the positions that go against you. So hedging M5, M15 or H1. You could also hedge using H4. Okay, I haven't tested it on H4, but I haven't traded it on H4 myself, but those timeframes are the ones that work the best. RSI dashboard or indicator plus market reversal alerts or the EA. That's all you need for this. Okay, so it's very, very simple. Step one, we wait for an alert that the RSI is above 60 or below 40. So we're not looking for price to be massively extended. If you want to, however, you can. So you could use 70, 30, 80, 20. And again, I would encourage you to experiment with this. So when the RSI gets extended on the time frame that we are trading, we take a trade regardless of direction. All right. So when RSI, whatever those levels are, pick a number. They can be anything you like. When we get up there, we go short. When we get down there, we go long. It is as simple as that. And we will take positions in both directions. We're hedging. Okay, so you have to be able to be working with a broker that allows you to hedge. So we take the trade regardless of direction. Step three, we scale in if price pushes against our initial entry, and we space our positions out at least half an ADR. I would recommend a full ADR, but half an ADR if you're going to go with a flat structure for your entries, i.e. you're going to take 0.02s on every entry, half an ADR is great. If you're going to use any kind of martingale where you're increasing your lot sizing as you go, use an ADR, minimum of 1 ADR. Otherwise, you will find sometimes you may get into big drawdown, okay, and you don't want to do that. And you'll have to obviously enact drawdown control a lot quicker. So we space our entries out the same way as we would as normal, at least half an ADR to an ADR apart. We take every alert that meets the criteria above, regardless of direction. So we just keep getting in as price moves in whatever direction, waiting for that profit-taking move to happen. Okay, so targets are half an ADR or a monetary value, in this case, like £10. So what I mean by the monetary value of £10, I would use a percentage of your account. So if you're trading a £3,000 or $3,000 account, for example, £10 is going to be somewhere around sort of 4 to 5% of 0.4 to 0.5% profit. So we're targeting a small amount of profit. These are scalps. These are hedging scalps. So we don't want to use big targets. We want to be in and out, and we want to take a small amount of money. But we're going to be doing it regularly because we're trading in both directions. So this way you will either just get half an ADR scalp profit, or if you need additional positions, you can target the £10 or the monetary value. So you would pick an amount that is equivalent to roughly 0.5% profit for you, okay? Or lower if you want to. The lower your target, the quicker you're going to get out of these positions. So hybrid martingale works well here. But if you're going to use that, you need to increase your spacing, ideally, to 1 ADR. But I'm going to show you an example of it using hybrid martingale in a minute. Considerations. This is a hedging strategy. So we are looking to profit from the natural ebb and flow of the market. So because of that, lower time frames tend to work better because we are looking for chop. We're looking for spiked movement up and down all the time. M5 and M15 are what gives us that. Higher time frames like H4, the movement is so much slower that the trades take such a long time to play out, it doesn't work as well. So M5, M15 seem to be best suited to this. When one trade loses, the other one wins. So we only worry about the trades that get squeezed if that happens, okay? So the danger here is we are not getting into positions when the market is extended, as I've said, or using multiple time frame analysis. So drawdown control may be required more often. And basically this is a screenshot of how hedging works. So we're using the M5 time frame in this example here. So you take entries when the RSI level hits the extreme on this entry time frame, so on M5. So literally, when we get above the level on RSI, we take shorts. When we get below, we take longs. Regardless of what positions we have on at the moment, we just get in. So we get short here, we get long here, we get short here, we get long here, okay? So it is literally that simple. We're using one time frame, and we are just trading the RSI, but we're trading in both directions. And what this does for us is it means if we were to take a short, okay, and it pushed against us, we have an opportunity to take another short. While we're taking that short, we can take a long and put profit in the bank. So we're making our P&L, can't we do that very well, that at, P&L, we're making it profitable. Okay, so we're banking profit constantly. So you can see here, we took a short there, but we banked twice, 3 times in the amount of time it took us to exit that short position. So this is from, this is Friday, Monday, Tuesday, Wednesday. Okay, so in 4 days, we banked 3 long profits and 1 short profit. So 4 profitable trades in 4 days. So every day we're banking money. Then we took another long there and exited it there. We took another short there and exited it there. Okay, because we're trading in both directions, we're continuously building a pot of cash. Our P&L is getting fuller and fuller and fuller on a daily basis. So if we do get a position that goes against us, because we're not using higher time frame analysis, we're not using that to tell us that the market is very extended on a higher time frame and we're going to get in on a lower time frame, there is an opportunity for the market to squeeze us further in one direction. So this is why you should ideally try to space your positions out. Okay, so here's an example again. We've got a sell there, 2 sells there. We took a buy here, a buy here, a buy here, and a buy here, and got out there. Okay, so this is on the hourly chart. All right, so this is moving up to the hourly time frame. You can see it's all happening an awful lot slower. So we got into a buy on that Monday, and it took 2.5 weeks to get out of the buy position. But while we were waiting, we pocketed sell profits. Okay, so we're banking money all the time we're waiting for these to play out. And obviously, as market moves down, we know there's going to be that opposite move coming as people take profits. Okay, so there is no higher time frame analysis. So we'll have a quick look at the EA taking some trades for us on this one as well. Let me just get my set file up so you can see what it's doing. So literally with this, we're just taking entries. We are using the current time frame. We're using the 14 RSI on 60/40, okay, in this case, and we're looking to target £15 or half an ADR. And this one, we're getting in half an ADR apart, all right? So we'll let this one run. I'll just put the timing on this. Again, I found a level that gives us some decent trades that work quickly. So that's the wrong time frame. So I'm going to run this one on M15. Llewellyn's just asked, does your spread not have massive impact on this strategy if using M5? No, because I'm targeting half an ADR. Your spread is going to be 1 or 2 pips, right? Your ADR is going to be something like, in this case, 130. So I'm targeting, so you see, we've just taken a couple of buy orders there, taken 3 buys and 1 short, as we've got extended on the RSI. So yeah, so the distance between trades is 67. So that's your target as well. I'm targeting half an ADR. So I'm targeting 60, 70 pips. If my spread is 1, 2, 3, 4, 5 pips, whatever it may be, that's not going to really come into it. Yes, you're obviously always going to have a spread. There's nothing you can do about that. But yeah, I mean, it does come into it. It's proper scalping where you're scalping real low timeframes. If you're targeting like 5 or 10 pips, which is what most people see as a scalp, yeah, I don't class that as a scalp. I class that as suicide. If you're trying to get 5 or 10 pips out of the market, you're going to get chewed to pieces, not only with stops, but with commissions, with spreads, with swaps, with everything. So I wouldn't do that. For me, a scalp is a short move. Remember, price moves in average daily range. For me, a scalp is a quarter to a half of an ADR. That's a small move because we know it moves an average daily range of 150 pips. So that's a decent target. Sorry, while I've been talking here, obviously we've been taking some trades. So you can see, obviously, we got into our first position here. Now, this is an example of obviously how you can go into more drawdown on these, because we haven't got a higher time frame RSI telling us that the market is already extended. We could be getting in down here when the market is high on the 4-hour RSI, couldn't we? So, but what we are getting on the lower time frames is much more of this. So as the market moves down on the higher time frame, it doesn't move down like that on the lower time frames. It moves down on the lower time frames like that. Every one of these is giving us an opportunity to get out, as you can see. So we've entered a long because we've been extended. We've had to get into 4 of them before we've taken our profit. But on the way, we took profit there. And we had another short position there, but we took profit there. And we've just taken another long there. Okay, so over the period of that 1 week, we've had 3 trades all turn into profit. So we've banked 1%, probably 1.5% on our account in a week. Okay, and that's just using that one pair. I'll let this one run on. It just continues to basically take trades, I believe, and keep banking profit. So we took a short there because we were extended there. We took a long there, obviously, because we were extended down there. So that short has played out while we waited to scale into this long. So all of these buyers, these sellers here, now need to become buyers. Okay. As it pushes down further, we take a sell profit, take another sell there. So this sell profit will happen. And then we will take another buy. So now we've got 3 buys on, but we've been banking profit all the way down with 3 sells, taking another sell there, another extension above the 60. And then we take another buy. That one there. So if this continues to push up now, we'll exit our buy position. If it continues to pull down, we'll exit our sell position. And we'll deal with the other positions as we need to. So it's pushed up, we've exited our buy, and now we've got a sell and a buy because we've had a trade in both directions. So we take the profit on the buy, and now we deal with the sell order. So all these buyers that have come into the market now will start to sell off. And if they continue to buy, we'll wait for the next profit take move and we'll get out on that one. Okay, so you can see how it just basically uses the ebb and flow of the market. And remember, 80% of the time, the market's doing that. This works fantastically well. If it pushes out and breaks out, it will pull back and profit take from that move, in which case we exit when it does that. So even when we get a breakout in the wrong direction, it will still have an ebb and flow as the market participants take their profits. And we're just literally riding those waves, but we're using both directions. Now, this is set up fairly aggressively here. We're set up at the moment on 60-40. Okay. If you want to, a better level would be 70-30, more of an extension. You'll get into less positions, but those positions will be more likely to put in their pullbacks. And again, 80-20 would be another level you could use. ADR spacing, at the moment we're using half. If you use 1 ADR, it will be less drawdown, but you'll still be able to profit from the same moves. Okay. So you can see there, we've taken another sell. We took a buy there. We took a buy, 2 buys there. We got a buy there. We took a sell there. We've taken another sell profit there. Okay, so we're continuously banking. We've got 1 sell on. We've got a buy. So a buy and a sell. Let me zoom in so we can see them a little better. So while we're consolidating, we're not losing money. We're not making money. So we've got another buy, taking another sell up there, and so on and so forth. So I'll stop it there. But obviously you can see what we're doing. We're just continuously banking money as the market moves with its normal ebb and flow. But the lower timeframes you are always going to find are going to be more effective for this type of strategy, because the ebb and flow and the chop is more prevalent on lower timeframes. Okay, but anything up to H1 will work with hedging strategies. And again, with all of these strategies, these are the ways that I use to get into the market. And you can fine tune these using RSI levels and spacing between ADR. Remember what we looked at yesterday, the things that affect drawdown, which is the only thing that we worry about with position trading. The things that affect it are your lot size, your spacing between your positions, and obviously your profit targets. So that's it for hedging strategy. Any questions on those, on that one? Of all the strategies, I would say that is the riskiest, but that will also generate the most profit. So you'll have to do more drawdown control with a hedging strategy, but equally your P&L will grow at an exponential rate, much, much, much faster. So there's pros and cons for each of the strategies. Okay, so all of those strategies are ways to get into the market at potential exhaustion points. You pick the ones that make the most sense to you and concentrate on that particular one. Okay, so I would recommend picking no more than one or two. The mean reversion strategy is my bread and butter. That is what I spend most of my leverage on. So the mean reversion, where we're pushing hard on one time frame, on the higher time frame. But do not trade every instrument under the sun. Whichever strategy or strategies you choose, just make sure you don't trade all instruments, okay? Remember the exposure rules, the 2-pair rule, okay? Remember your exposure is very important. The more pairs you get into, the more potential drawdown you're going to have, okay? You will find multiple instruments alert at the same time with all of these strategies. Because what you're going to find is currency pairs will push at the same time. So if the pound is pushing hard in one direction, you will also find that all pound pairs will alert at the same time. So if the pound does that, you will find pound New Zealand, pound CAD, pound yen, pound US will all give you an RSI alert or an ADR alert. Okay, because they're all going to push at the same time. So make sure you just pick one or two of those to trade at most. Okay, so make sure you're filtering your trades to pick the best setups. And if you see pound CAD, pound New Zealand, pound odd, pound yen all alerting at the same time, look at all four. Which of them is hitting a good support and resistance level? Which of those looks like the best one? Pick that one. Okay, you've got to pick one, you can't pick them all. But if you do want to pick them all, make sure your lot size is half of what it would normally be. Performing your own back testing with the EA. Okay, so you can easily test and refine these strategies yourself using the Market Reversal Alerts EA. You can download a demo of it, play around with it. Okay, that's how I've fine-tuned my strategies over the last year. Since I built the EA, it's allowed me to do faster, more automated back testing and analysis of levels of RSI and all sorts of things, drawdown and everything. So use the EA if you've got it or if you want to get it, because it will speed up your learning curve with position trading a lot more. If you're going to test using the EA, always start with control points as initial test. Okay, it's faster and it will give you an indication if a change is positive or negative, or even if the strategy works at all. Ideally test it with tick data. Okay, so you can purchase tick data suite, which integrates with MT4 and gives you a much greater time ranges and accuracy for your tests. So I'll just quickly show you tick data. So the tick data is here. I have this. You won't have this in your MT4 if you haven't got tick data, but I can download tick data which goes back over a decade, okay, which allows me to use data that is more accurate and over a longer period. So I can test strategies over a longer period of time to make sure they're robust. Okay, so tick data is it's worth getting if you want to do it properly. It's something like $50. It's a one-off purchase, and you will have it there to do thorough testing. So I'd highly recommend it. Once you've got a strategy that looks good, back test it again on every tick setting, so to give you the confidence that it works on micro data, because the control points is not as accurate. However, I found it to be virtually the same, to be honest. And then apply the strategies to other instruments to test robustness. Okay, so if you find something that works well on the pound US dollar, for example, go and test it on the other pound pairs. Test it on some euro pairs. See how robust that strategy is. See what difference it makes to drawdown. See which pairs work well. And then apply it to other timeframes to see if you can improve it or if it gets worse. So if you find a strategy like the ones that I've got that work really well on M15, how well do they work on the hourly? Do they give you half as much drawdown and produce the same profit? Brilliant. Switch to hourly trading. Okay, so if you want to use the EA, that's what it's for. It was developed as a back testing tool and to automate simple entries with my strategies. And it's invaluable in that respect. I'm going to be doing a lot more back testing with the EA in the live rooms as well. So if you want to join me in the live rooms, you can do. And we're going to dedicate an entire day in the live rooms to back testing each week, just to try and develop and improve on the strategies and come up with new ones. Yeah, so you can use this on any strategy. Okay, the methodology of position trading isn't just restricted to RSI and market reversal alerts indicator. You can use it on anything you like. It's just a way to get in and get out of the market. Okay, so that's my setups. Final notes, you will have noticed how virtually every setup I take revolves around exhaustion, whether it's mean reversion or trend pullback. I'm looking for price to be tired. Remember the elastic band. If you take one thing away from this entire boot camp, remember that elastic band. Okay, when the elastic band is stretched, it means there's too many people in one direction. Those people have got to go in the other direction to make a profit. At some point, there will be a pullback or a reversal on that move. RSI is king. I never take a trade without consulting the RSI and making sure we're ready for that pullback or reversal. If the RSI is king, patience is queen. You'll have many times where price consolidates and goes sideways for days or even weeks without it hitting your target or getting you into more positions. This is part of trading. We have no control over price. There's nothing you can do about it. Okay, you have to just accept sometimes your trades will sit there for days, and you will have days and weeks where you don't bank any profit. It happens. It's rare, but it happens. Okay, so you're going to have to get used to it. You have to be patient with this strategy. We've got our pies in the oven. It's a kind of a terminology that I use a lot of the time in the live room. Okay, so when we're entering into trades in our positions, we have got our pies in the oven. We're waiting for it to cook. So that RSI gets extended. We put our pies in the oven. When it pulls back, they cooked. We take them out and we make our profit. Okay. Sometimes things just take a long time to cook. Okay. Exposure and over leveraging with too large lot sizing on too many pairs is always the downfall of people who fail using this strategy. Trade small, 0.01s, 0.02s, and get used to being in drawdown. Get used to seeing your drawdown build, get used to seeing your drawdown disappear and turn into profit. Allow the trades to play out and work so that you can see these market cycles working and how quickly 5 or 10% of drawdown vanishes in one swift move on news and your bank account grows as a result. Okay, trust in the methodology. Try it for a month, use the live room if you wish, okay? And yeah, basically just go and trade. Just before I finish up on that, the live room is run every day at 12:30. If you wanted to come in and utilize that, I do an every pair analysis, look at open positions, I take trades, I act on alerts, live chart analysis, basically just me doing everything I've just taught you over the last 5 days. Okay, so it's just me doing it in a live session. There's a Q&A every day, obviously. At the moment, I've got a new schedule which is starting next week. We're going to be doing profit analysis and opportunities every day of the week. So we'll be looking at what we've closed out, what we've banked, where our current positions are, opportunities in the market. Okay, Mondays, we're going to do a full market overview of every single pair. We're going to look at what's called the Commitment of Traders report, which is something else I can introduce you to. It's not necessary, but There's something else that you can look at to give you directional bias as well. We'll do an overview of all the pairs. Backtest Tuesdays, we're going to be looking at the EA and doing backtesting, trying different strategies, trying to improve them, seeing where we can increase and decrease our drawdown rates. Wednesdays is a midweek analysis of every pair again. And then Thursdays, we're going to do live lessons. So anything you want to know about, any parts of this particular bootcamp or anything else you want to know about trading is basically a pick my brain session. We'll go over the same lesson every week if we need to, if there's things that people don't understand. Okay, so it's just basically more knowledge. And then Fridays, we do an end of week profit analysis where we look at all of our trades for the week, what we've banked, what's gone right, what's gone wrong, learn from everything that we've done that week. All right, so that's the plan for the live rooms moving forward. Any questions? And this is the last Q&A slide. Okay, so from day 1, 2, 3, 4, or today, anything you've got to ask now. Burning questions. Do you offer a 7-day trial for the live room? No, but I can do. I'll get back to you on that one. Thanks for a lot. Your efforts to help others is truly admirable. Thank you very much. It's very nice to hear. I tried to help. The reason I've put this together and I've put it out there for free is because I've been trading a long time, and 2 of my mentors did the same thing for me. One of my first mentors had been trading for over 20 years, and he took me under his wing and he taught me for free. And he put together an entire course 10 times bigger than this. And he mentored me for free. And I got way more out of that from somebody that had been in the game for a long time than I had ever got from any video course that I've done. So the reason I'm not charging for this is because I'm giving something back to the trading community. And it's been given to me in the past. So I believe in passing it on. But also I do sell indicators, obviously. So I am being paid in a way for what I'm doing, but hey, that's what we're here for, to pass on knowledge. With so many currency pairs, are there good combinations of currency pairs to work on for starters? No, the difficulty with, and I've been asked this question before, which is why I know the answer very easily. The difficulty with limiting your pairs is you're limiting your opportunities. If, for example, you were to pick the 6 majors, for example, or the US crosses, and the US dollar went sideways for a month and consolidated, you would never get an alert and you would never get an opportunity to trade. Whereas you might find the yens and the New Zealand and the pound were going crazy and giving alerts left, right, and center all month. Up, down, up, down, up, down, opportunities to trade every week and make money. But if you limited yourself to just those pairs and they never gave you an alert, you would never make money. So you're better off monitoring all 28 major and minor forex pairs and picking the ones that you think are the best. And as I said, you're going to get alerts on lots of pairs. Okay. So I've got alerts on multiple pairs here right now. Okay, so if I was only trading Euro New Zealand, Euro US, Pound Odd, Pound CAD, and Pound Swiss, I wouldn't be getting any alerts. So look at everything. When it alerts, look at it. If it's a Euro CAD trade, for example, and you're already on 2 euros and it alerts, you don't look at it, do you? Because you've got Euro on. So just you look at all pairs, they all move. And the reason we use average daily range as a measurement for targets and for spacing our positions out is it doesn't matter what pairs you trade. If it's a pair that doesn't move very far, your targets are small. If it's a pair that moves massively, your targets are massive. Okay, so we adjust our targets based on the currency pair or the instrument we're trading. If you want to trade the S&P 500, that's got an ADR of about 500 pips, fine. You trade it the same way as you do everything else. It's just that the ADR will mean that you will get in further apart with your entries in pips, but your targets are going to be the same, aren't they? So trade everything, trade whatever you want. Indices, if you want to trade crypto like this, I've never tried, but crypto markets move. Everything moves. If it moves and there's buyers and sellers involved, these strategies will work because if you buy and you don't sell, you don't make money. So if I buy crypto, if I buy Bitcoin, I've got to at some point sell Bitcoin, haven't I? Okay. But Bitcoin's a little bit different, obviously, because that just goes to the moon for no reason whatsoever. I don't understand it, so I don't trade it. That's why I don't do crypto. I trade FX because I've been trading FX a long time and I understand it. But gold, things like gold, metals, indices, you can trade anything. But try to limit yourself to FX pairs. I always say you've got 28 FX pairs. Okay, if you can't make a living out of 28 FX pairs, something wrong. There's a lot of opportunities every day, so just use those as a starting point. All right, so that's it. So I've got one final slide. Hopefully, welcome to the 5% club. Okay, so we all know 95% of traders fail. Hopefully, we can become now one of those 5% that pass. It's more like 99%, I would say, but hey, 1% club doesn't sound as good as 5, does it? So that's the end of the course, end of the boot camp. Hopefully you've enjoyed it. If you have any questions, I'm available in the Telegram group. If you want to find out more about the indicators, obviously, and get in touch with me, you can go to themarketstructuretrader.com. There's links to the Telegram group, to Facebook, to YouTube, everything from the website there. I put all the information up on the website. You can join the live room if you want to. And hopefully, if you try this for a month, we can get you cracking that 5 to 10% profit level per month. But give it a go, see how you get on, and good luck.